Welcome back, accounting students. We are currently working in chapter 14, and we are all the way up to lesson 3 in chapter 14, which is promissory notes. One thing that you want to consider is that in previous lessons that we really learned about buying and selling on account, that sometimes a vendor or customer needs an extension of time to pay on the account. So in this particular lesson, we're going to learn how to account for credit that is extended for a longer period of time. So I think that's going to help. One of the things that you're going to want to know about this particular lesson is that there's a lot of vocabulary involved here. So this is probably a good opportunity for you to grab your book, open up to page 425, and notice all of the yellow highlights that are listed on page 25 in terms of vocabulary. Some of it's going to be a refresher, some of it's going to be new, and we'll just want to make sure that you have a good understanding of all of that vocabulary. That's going to really help us where we progress through this particular lesson. So what are the objectives of this lesson? To record the acceptance of a note receivable, to account for the collection of a note receivable, and then to account for a dishonored note receivable. All right, here we go. So a written and signed promise to pay a sum of money at a specific time is called a promissory note. And the business or the person to whom the liability is owed, so the person that's going to get the money, that's the creditor. A promissory note signed by a business and given to a creditor is entered in the business books as a note payable. And a promissory note that a business accepts from a customer is entered in as a note receivable. So from here on out, lots of times this is just referred to simply as notes. The person or business that signs the note and makes the promise to pay, that is the maker of the note. So the person who is responsible for making the payment, they're the maker. The person that's going to be receiving the money, they're the payee. The amount of the note, and this is sometimes called the face amount, that's the principal. Oftentimes we'll translate this into, hey, a loan at a bank. The amount of money you borrow, that's the principal. The percentage of the principal that's due for the use of the funds, that's interest rate. So we don't let people use our money for free, and so we charge interest on that, and that's called the interest rate. The day that the principal is due to be repaid is called the maturity date. And then the amount of time between when the note is signed and the maturity date is called the time of the note. Oftentimes we just call this the term. And this is usually expressed in the number of days, 30, 60, 90, etc. Okay, so we're looking at an example of a promissory note here, and we can see this is note number 6. It says, for the value received, the signer promises to pay the creditor, the order of 3 green products, 90 days from the date, the principal sum, $25.78.35. Okay, and you can see then that the 8% is the annual interest rate, and then the day, the maturity date that amount of money is due, June 16th. The maker of the note signs, and then there are some witnesses that sign saying, yes, we agree to this relationship, this promissory note relationship. So accepting a note receivable from a customer, we want to make sure that we go ahead and put this in our general journal. So on March 18th, we accepted that 90-day note at 8% from Skinner College for an extension of time on their account. So in the general journal, you can see that a debit is going to be to notes receivable, and then the credit is going to be to accounts receivable. So we're actually going to go ahead and reduce the amount of our accounts receivable, and we're going to transfer this over to our note receivable. The accounts receivable ledger then for Skinner College gets zeroed out based on this, this note payable from them. All right, so in the general journal, we're going to go ahead and post this then. So on the 18th, to notes receivable, and the note receivable number is number 6. The credit, the account title and the customer name is what goes in the general journal, so accounts receivable Skinner, and the amount that we're going to be crediting. All right, so when we do promissory notes, we always want to make sure we're charging interest for that. So interest time, the principal amount times the interest rate times the amount of time is what gives us the actual amount of money that we're going to be collecting for the interest here. So the amount that is due on the maturity date is the maturity value of the note. So principal plus interest equals maturity value. And you can see on this particular note, when we multiply the principal times the annual interest rate, we want to make sure that we're doing some kind of calculation to account for the fact that we're going to be charging the 8% over just 90 days instead of the whole year. So that's why we include this calculation about a fraction of the time of the year. And our principal plus our interest that we're going to be receiving is the maturity value. Okay, so maturity date on promissory notes. You want to make sure that you know how many days, and you accurately use the number of days on a 90-day note, because not every month has the same number of days in it. So if you're issuing a 90-day note, you wouldn't automatically say, okay, today is March 11th, that's going to be due on June 11th. So you're going to go ahead each time you issue a note and figure out how many days later the note is actually due. And so this chart is showing you, hey, the term of the note is going to be 90 days, how many days are in the month, and then how many days in the note would be remaining to get you all the way down to the actual maturity date. Okay? All right, so collecting the principal and interest on a note receivable. When a note receivable reaches maturity, then the maker of the note is expected to pay the maturity value. The interest that we earn on this is now interest income, and the interest earned on a note receivable is credited to a revenue account that we title interest income. So we're going to have a separate account where we go ahead and post interest income. So you can see we are going to debit cash, and we're going to go ahead and credit notes receivable, and then we're going to go ahead and credit interest income. So here's our cash receipts journal. On the 16th of June, we're going to go ahead and credit notes receivable for the receipt of the money. And notes receivable gets a credit of the original amount of the note, and then interest income gets the interest piece, and then we're going to debit cash for the total amount we received. All right, a note that is not paid when it's due is called dishonored. And you can see right here, Stout Company dishonored our note receivable number 4, which was a 60-day 8% at principal of $3,000, interest of $40. So in our general ledger, we're going to go ahead and debit accounts receivable. We're going to credit notes receivable. And we're also going to go ahead and credit for the interest. So you can see in the accounts receivable ledger for Stout Company, we're going to go back and debit the account receivable to show, hey, they didn't pay our promissory note, so they still owe us that money. All right, in the general journal, on June 3rd, we're going to see the accounts receivable for Stout Company, according to memo number 98, is going to be debited for the $3,040. Our note receivable of $3,000 and our interest income of $40 are going to be credited then. And then again, this note was dishonored. It wasn't paid when it was supposed to be paid, so that's why we want to note this. All right, so What conditions might cause a business to delay payment to a vendor? The receipt of cash from sales does not occur at the same time and in amounts that are sufficient to pay for needed purchases. So the reality is sometimes businesses don't have the sales revenue that they need to pay their bills. And if that happens, then they might not be able to make payment to a vendor. What is the advantage of a promissory note over an accounts receivable? And using a promissory note actually can be incredibly helpful in a court of law as written evidence of a debt. So as a business, if you have a vendor that signed a promissory note with you, then if you ever need to go after that person in court, which as much as it stinks to have to sue someone, sometimes you do, then you have some evidence that that person actually owed you money. What does an interest rate of 10% mean? 10 cents will be paid for the use of each dollar borrowed for a full year. So always remember, interest rate is always, did I mention always, listed as an annual number, which is why when you looked at that promissory note originally, we had to do some calculation to make sure that we accurately calculated the amount of interest that we should charge for 90 days as opposed to the whole year. What is written in a customer's account when, number one, a note is accepted, and number two, when a note is dishonored? So when the promissory note is accepted, you write in there accepted note. And when you have a note that's dishonored or they don't pay, then you write dishonored note in the item column on the customer account. All right, so hey, we're at the end of lesson 3 in chapter 14. And one of the things that you definitely want to be thinking about in this particular lesson as we wrap up is the idea about when you would need a promissory note and why you might need a promissory note, and how promissory notes can be really helpful in a business situation. That would be a big idea to make sure that you can continue to carry forward. From here, please go online and complete the forms, and then go ahead after you complete the forms and do the work together and on your own. And after that, you can proceed to the applications for chapter 14. Good luck, everyone. Come see me if you have any questions.